Let me ask you something that most financial advisors won't tell you. Right now, somewhere on the stock market, there is a company, a profitable, debt-free, cash-generating machine trading at half its actual value, maybe even a quarter. The stock is cheap, not because it's broken, but because nobody is paying attention to it, because the market is emotional, irrational, and short-sighted. And when nobody is watching, that is exactly when you should be buying. These are what I call sleeping giants. In this explainer, I'm going to show you the exact system I use to find them before everyone else does. This is the FTP method, and by the end of this explainer, you'll be able to screen any stock on the planet in under 5 minutes. Let's go. Welcome back. If you're new here, my name is the Enthusiastic Explainer, and this channel is dedicated to one thing: helping you build real, lasting wealth through intelligent investing. Today, we're starting at the absolute foundation to hunt for those sleeping giants we just talked about. By the end of this explainer, you will understand the FTP method. You'll know exactly how to read a company's financial health, and you'll have 4 specific magic numbers that act as your automatic stock filter. No fluff, no filler, pure strategy. Let's begin. Okay, let's dive into this, section 1, the paradigm shift. We're talking about value investing. Because you see, before we can even get to the math and the magic numbers, we absolutely have to understand the philosophy that drives them. This whole philosophy was pioneered by the legendary Benjamin Graham. The core idea: buying an asset for significantly less than its intrinsic value. That gap, the distance between the cheap price you're paying and the true fair value of the business, is what we call your margin of safety. It's kind of like being a property investor. Let's say you know a house has an intrinsic, true value of $500,000. But, maybe the current owner is desperate to sell, or the neighborhood temporarily has some bad press, so the asking price drastically drops to $300,000. You buy it. And you're not buying it because it has nice curtains, right? You buy it because you know what the asset is actually worth. Value investors do exactly this, but with stocks. We buy when the emotional market temporarily misprices a totally great asset due to panic or just simple neglect. So how do we systematically find these mispriced companies? That brings us to section 2, the framework, the FTP method. Our source material relies heavily on Dr. T's framework, which is the FTP method. Think of it like a 3-legged stool. For you to sit on it safely, all 3 of those legs have to be rock solid. Leg 1 is fundamental analysis. This examines the financial DNA of a company. It basically tells you what to buy. Leg 2 is technical analysis. This studies the charts, the trends, the market timing, so it tells you when to act. And leg 3 is personal analysis. This is where you read the psychology of the crowd, and honestly, yourself. It tells you why the market is wrong. Every single investing decision you make has to be filtered through all 3 of these lenses to minimize your risk and make sure your stool doesn't just topple right over. Moving right along to section 3, the engine, company medical records. Look, before we can calculate any magic numbers, we have to look at the 3 financial statements. Think about it like this. You would never let a surgeon operate on you without running some basic blood tests first, right? Well, you should never, ever invest your hard-earned money without doing a proper medical exam on the business. Step 1 is checking the income statement. This tracks profitability. We want to see consistently growing revenue and growing earnings per share. Step 2 is the balance sheet. This measures financial strength by weighing what the company actually owns, its assets, against what it owes, its debt. And then step 3 is the cash flow statement, which verifies the actual physical money moving in and out of the business. And honestly, this next point was a massive light bulb moment for me. You cannot fake cash. A company's management can easily use legal accounting tricks to manipulate their income statement so they look wonderfully profitable on paper. But cash either moved into the bank account or it didn't. The cash flow statement is literally your lie detector. Operating cash flow must be consistently positive. If a company is reporting massive profits to the public, but they somehow have negative operating cash flow, you have to walk away immediately. No exceptions. All right, here is the climax. Section 4, the filter, the giant screen. We are going to take 4 magic numbers derived from those medical records we just talked about and use them to automatically filter out 99% of stocks. Let's unveil the very first magic number, 15%. Your return on equity, or ROE, absolutely must be greater than 15%. So what is that? Well, ROE measures exactly how efficiently a company's management uses shareholder money to generate a profit. If you give a business $100 and they return $15 in profit, boom, that's a 15% ROE. If a company can maintain an ROE above 15% consistently over, say, 5 years, it proves beyond a shadow of a doubt that their management team operates a highly efficient profit machine. And that brilliantly illustrates our next metric, the price to earnings or PE ratio. Imagine there are two fruit stalls selling the exact same apples. Stall A charges $5 an apple, which gives it a PE of 25. But stall B over there, they charge just $1 an apple, maybe because the owner's retiring, giving it a PE of 4. Now, smart shoppers go to stall B, right? The PE ratio makes this instantly understandable in the stock market. It just tells you how much you are paying for every single dollar of a company's annual earnings. Which brings us right to our second magic number, 5. We are actively looking for a PE ratio of less than 5. When you find a highly profitable company that has a PE ratio under 5, it means you are paying a deeply discounted, incredibly cheap price for every single dollar of their earnings. You are essentially buying your apples at stall B for a massive bargain, while the rest of the emotional market is completely overpaying over at stall A. Let's hit the third magic number, 0.5. This applies to the price-to-book, or PTB, ratio. We want this to sit below 0.5. Now, book value is basically what the company would be worth if it completely shut down today, sold off all its assets, and paid off all its debts. If you buy a stock with a PTB below 0.5, you are quite literally buying the company's underlying assets at a 50% discount. It is the exact equivalent of buying a crisp $100 bill for $50. It provides an absolutely incredible natural floor on your risk. Finally, we arrive at our fourth magic number, 5%. We want a dividend yield greater than 5%. And here is exactly why this matters. Value investing requires patience, a lot of it. It takes time for the irrational market to wake up and correct a stock's price to its intrinsic value. A dividend yield over 5% ensures that you actually get paid passive income simply to wait. It's just like collecting monthly rent on a property while you wait for the property's market value to go up. Let's consolidate all of this. Here is your entire giant screen checklist. Return on equity greater than 15%. Price to earnings ratio less than 5. Price to book ratio less than 0.5. And a dividend yield greater than 5%. Listen, when a stock passes this specific gauntlet, it pretty much guarantees your margin of safety. It means you have found a highly profitable cash machine trading at a massive discount, backed by solid assets that literally pays you cash just to hold it. So, I want to leave you with an empowering challenge today. Think of a stock you currently own in your portfolio right now, or maybe one you've just been watching closely. I want you to pull up its medical records and run it through these 4 magic numbers. Does your stock pass the giant screen? Or are you overpaying for a popular name without any margin of safety? Go find out if you're holding a true sleeping giant. Stay focused, stay rational, and I'll see you in the next explainer.